My name is John Stenhouse. I'm the Business Support Manager at the University of Essex, and welcome to the webinar series Space to Grow Investment Readiness, part of the University Enterprise Zone offering of help and support to growing and nurturing innovative businesses. Very pleased to have with me today two of my entrepreneurs in residence, William Nitin, who's a fellow of the Judge Business School, and Dr. William Millar, who is a fellow of the University of Ulster. Both of our entrepreneurs in residence are here to help and support businesses with their opportunities and help them grow and develop to the point where they can receive investment. And that is the key to this program. We aim to help businesses grow, and we are looking for those innovative businesses that are going to change the world. And believe me, the world needs changing, doesn't it? I have with me Josh, who is an able assistant who will deal with all the technical aspects and correct me when I go wrong. This session is being recorded and it will be made available on YouTube later, so no need to ask. You will be sent a link, and we do appreciate the audience comments. So any feedback after the event, we will take that on board. This session will last roughly 1 hour. There'll be plenty of opportunities for Q&A, questions and answers. And if you look at the bottom of your screen, or the top or the side, depending on which device you're using, you'll find Q&A. Please use the Q&A to ask any questions. We don't use the chat box in this instance, it's Q&A. Thank you. We'll answer questions. We're guaranteed to answer questions by the end of the session. But if it's relevant, we might actually include it as part of the conversation. Now, we like to know as much about the audience as we possibly can. And so we are going to be asking you some questions during the course of this webinar. So please stay alert, because we do like to hear from you. So I would now ask Josh to actually ask the first poll.
Yep, thank you, John. So the first poll, everybody, of the day is, have you already decided on your investment strategy? So it's a simple yes/no question, so you should see that on your screen now. So as we can see, the majority of people today haven't decided on their investment strategy, which is great. So hopefully William and Nitin can share their knowledge with you and get you thinking about your strategy.
Thank you, Josh. So I would now actually like to hand over to William and Nitin. As I said, William is a doctor of engineering, I believe, if my memory serves me correct. Nods there, and is a fellow of the University of Ulster and an entrepreneur in residence at the University of Essex. Nitin is also an entrepreneur in residence at the University of Essex and is also a fellow of Judge Business School from Cambridge, highly prestigious Judge Business School, I hasten to add. And we are very pleased to have our two honourable gentlemen presenting today. So, William, would you now like to share your screen?
Good afternoon, everyone, and thank you for taking time to join the webinar, and thank you for giving us the opportunity to speak to you. Our agenda this afternoon is focused around the contents of a pitch deck, our view based on experience of looking at a number of pitch decks as to what the best format for those should be. We'll finish with a summary and give you the opportunity to ask questions at the end. But really, just before we start that, we wanted to make sure that in seeking equity investment, that is the right thing for you. So what does it mean when you're looking for equity investment? Well, very simply, it means that you're selling part of your company in the form of shares. So the obvious statement from that is that you must have shares to sell. So that means that the company structure must be right, that it must be set up in such a way that there are shares there, that they can be sold, that there's a return on the investment that the investors can make from the sale of or from the purchase of those shares. It brings others into the company. So an investor coming into the company creates a different dynamic and a different relationship within that company. They're coming in, they may be coming in to give some advice, add some expertise. That may be what you're wanting them for, as well as for the money. So be prepared to listen to the investors. It's no longer just you that's in the company and running it. Another question to ask yourself is that investors are looking for a return on their investment. Typically, that can be a 10 times return in 5 to 7 years, or it can be even less than that. So can your financial projections, the revenue that you think you're going to get out of the business that you're setting up, the profitability, can it support that? And if it can't, then maybe equity investment isn't the right thing to look for, or you're looking for a specialist kind of investor. And remember too that when you set up a business, that other forms of investment are available. You can borrow money. Quite often businesses are set up with borrowing money from friends and family. As you may also be able to get funding from a startup loan company, which is a government-backed loan fund, or you may be in some specialist circumstances able to get a grant. Usually startup businesses aren't eligible for grants simply because they don't have a trading history that will support the growth of the business at the initial stage, and hence grants are difficult to get. But in some cases, a startup business can get that. And remember overall that equity investment isn't the simple thing that is shown in Dragon's Den, where you come in and pitch some information and lots of the investors or the dragons give you money from the side of their table. It's a much more longer journey than that, more complicated. There will be ups and downs along the way, so be prepared for that journey when you set out. So I think now we're going to have another poll which Josh is going to run, and it's really asking the question, have you established a valuation for your company? Remember, you're going to sell part of the company, so you need to know how much that's worth.
That's it. Thanks, William. So you should be able to see that on your screen now. And again, it's a simple yes, no. As William said, have you established a valuation for your company? So as we can see, the majority haven't established a valuation yet. So what I'll do is I'll stop sharing those and I'll hand back over to William and Nitin.
Hi, good afternoon, everyone. Hopefully, those of you who've heard this webinar before, we're pretty consistent. We're always adding to the situation as we learn more as well. And like best things, we tell you what's needed first, and then you've got to work your way through it. So the summary there is highlighting around 12 or 13 slides that goes to make up a pitch deck. Some of the key areas to focus on when you're actually looking to create your pitch deck is the problem, because there is no point trying to find a solution for something you don't understand is a problem. So the key really is to understand what you're trying to find the solution for, have a really good understanding why the solution is needed. And in a lot of cases, the problem arises from your own personal experiences, either because you're working in an area that you can't find something that you need, or you're linked to somewhere that there is a problem that you know needs resolving. And then as we go down there, it's a flow through which takes you from the problem to creating a solution. Again, make sure that the solution is put together in a way that it's easy to understand. Now, not all solutions in the area of innovation can be easy to understand for people, but it's your job to try and simplify as much as you can without losing the thread of what you're trying to put together. So it is important that you actually look at it and stand back when you're putting your pitch deck with the solution together. And the rest of it sort of comes, as you can see, the body of the presentation. The key comes towards the end. The team is a very important piece of the jigsaw. And again, it's important that you highlight the key members and the key strengths and ensure that the match of the team is pretty good, and explain how it came together and how you all work together. The business model is important because a lot of these new innovations have different ways of how you generate revenue and wealth for the investors. So it's also important that it's put in a fashion that's easily be explainable in how the money comes in, where it's used, and what the benefits will be for the investor. And one of the other elements on there is looking at your competition and IP. Bill, do you want to add anything to it?
The only comment I'd make at this stage is that overall the deck has to be a very good representation and presentation of your business. So make sure that the investor can understand it. Don't include technical jargon because they may not understand that. Make sure that you spell check the slide deck as well, because if you get an error in a slide, that can put people off. It makes them think about what was supposed to be in that place where there is the error. But it also says to the investor, I haven't really taken the time to check this, so I might not take the time to check other details in my business.
We'll go through these now in a sort of reasonable detail and add to some of the key areas we look for. As I said, the problem statement, it's always important that the problem you're resolving is real. Even if it's hard to explain, you've got to get it to a situation that someone can relate to it in a real situation. As Bill has already said, describe it in simple terms and know how you have got around understanding why this is a problem, because the best experience is personal experience. And who do you think this solution is aimed for? At this stage, having done that little work makes the thing real, and more, it sort of helps you flow as we go through the process of developing the deck. Bill?
Yeah, I'd comment that you should think about the problem from the investor's viewpoint to start off with. Will they recognize it as a problem? So you may have real in-depth experience of what the issue is, but that may not be something that the investor will recognize. So can you present it in such a way that the investor realizes it is a problem and they can relate to it? It may be something that's specific to a particular industry. So you may want to present it in terms of what the end user of your solution is actually going to do once you've gone into business. And that will help them understand the context of the problem itself. It's really here that you get the opportunity to establish the need for your business because you've stated the problem. Occasionally, and very occasionally, there is no need and you're really creating a new business out of something completely different. That's very innovative, and very few companies have the opportunity to do that there. It's usually the large enterprises. So
okay. Yep. So the solution statement, this is one of the keys to getting people other than yourselves on board. The solution really needs to demonstrate that the problem you've highlighted will be solved. And it's really important that it's defined best you can. I mean, some cases in early stages, it's hard to have all the detail around, but you've got to take them along the journey that the start of what you're suggesting as a solution fits the problem, and then they'll be willing to work with you as you go down that journey. So it is really important, as you know, we've said a number of times in the conversations about jargon and stuff, you being involved with the particular technology will understand all of that, but sometimes it's very hard for other people who are not to be. So this is an area where you again have to look at what you're trying to get across to someone from a differing type of people who will look to invest. One of the challenges that we've sort of experienced over the period we've been doing that, the profile of investors have changed. You know, traditionally it was an angel area where people would know the sort of businesses they were in. More and more we find that people are looking to invest with the aim of understanding something they can, but they know it's a risk area, but they're looking for benefits of big returns. So it's a challenge to make sure you can cater for all the different type of people who now have the capacity and capability to invest if they choose.
An obvious statement from me is, does the solution relate back to the problem? You know, is there a clear flow from the problem that you've identified to the solution that you've identified as well? That may seem obvious, but sometimes that doesn't come across too well in a pitch deck. And be aware at this point, once you've defined the solution, you're opening the door to a lot of other questions that will come up. And I call them the why questions. So why is your solution the best solution there is? Why will people come and buy from you? Why are you best placed to deliver it? And why now? Why is now the right time for this solution to go into the marketplace? And remember, those are the kinds of things that the investor will be thinking once they've understood what the problem is and what the solution is. They'll be thinking of those in their mind. So you've now got the opportunity to answer them as you go through the remainder of the deck. And if you don't answer in the deck, they will probably come up as other questions from the investor. So be prepared to answer them.
This is an interesting situation because it clearly needs to cover exactly what you need in terms of getting the project forward. And it's very important also that you have a valuation that the percentage you are now putting out to equity in terms of investment fits the numbers. So it's important work at this stage to try and get a good understanding of the valuation. And again, there's quite a lot of people on here who said they valued the company. Make sure that you can sort of stand the scrutiny of an investor as to how you've got that value. It's not an easy situation to find values for early stage startups or pretty developed businesses who are looking for investment, particularly if they're not in revenue. But it is important that when you're asked the question, you have a very robust discussion around why you suggested where that value is and comparisons of other industry peers and alike. And then you clearly need to understand where the money you're asking for is going to go towards developing the business.
A couple of comments that be careful not to give too much equity away in the business in the early stages. And the other comment is that ultimately the value of the company is whatever the investor is prepared to pay for it and whatever you're prepared to accept for it. So it does become a negotiation, which is why Nitin's saying be very sure of the valuation that you've got and why you've got it so that you can justify it. The other thing is that you may not just be looking for money from the investor, you may be looking for something else from them, for their expertise, their network of contacts, whether they can open doors for you into the companies that you're going to sell if it's an enterprise solution that you're developing. So be aware of all of those things that you may want from an investor and also what the investor is going to want from you at that point.
And I think we covered this a little bit on what will the money be used for. This is really important to understand that you know the detail of where every penny that you're looking to invest from the investor to go to. And some of the key things as highlighted there, they shouldn't necessarily be for salaries and cars unless you're a business that's already in profit and looking to grow 3 or 4 times already. So it's not something that we would really expect the companies we talk to would be doing with the investment they're taking on. And it is very clear that you should know exactly what you plan to do with the money when you get it, because there's no point someone saying there's the money ready for you and you still not got the plan together on how you'll spend it. And it's a lot easier than people think, but it's very important that when someone gives you that ability to take the money, that you're prepared to take it and spend it as planned.
Yeah, I think it's important that you know in detail what it is that you are going to do with that money and how it's going to relate to growth of the company. Sometimes we see decks which say we're going to recruit 3 people at, say, £30,000 per annum, and that's what we want the money for, but it doesn't actually tell me as an investor what those people are going to do. So it may be that you've got development work to do if it's a software solution you're developing, and hence you want to recruit a developer in order to develop the next phases of your particular solution. Or it could be that you need somebody with digital marketing expertise, so you're going to recruit someone with those skills to develop your brand and grow your presence in the marketplace. So it's better to think of what the outcomes are that you're going to get from the investment, rather to think of what the input is in terms of salaries. and also be aware of what it is that you're going to do internally and what you're going to do externally, particularly if in something where you're developing, say, software component, or you're going to subcontract the development of some widget to another company. But particularly with software, if you're doing that outside your own business, make sure that you have that well under control, know exactly what you're going to get and when you're going to get it and how you're going to manage it. Because quite, as everybody would know, software development takes longer than expected, costs more than expected, and usually delivers less than expected. So make sure that you, if you're developing software and that's being done outside, it's well managed and well controlled by you, and you understand the risks. And then finally, be aware that you need to defend each spend item. We see sometimes people putting up, we need £18,000 for an office in London. Well, question in today's world, do you really need an office in London? Can much of the work not be done online through Zoom calls and things like that there? And maybe you only need a hot desk in London. So make sure that you understand exactly what your cost build is going to be and that you can justify it.
Okay. Now, this is one of the key areas for a lot of early stage startups to understand. Clearly, you have to understand where your aim is in the market that you are going to get into. But it's not as simple as taking the size of the market and then dragging it down by percentages and then saying, 1% of £1 billion market is a big number that I can get. It's important that you clearly understand where your product will serve the market. How different is it from the existing competitors in that area? Because as we've said, it's very rare that you will find something that is totally new. Most of the time you will be improving something that's there or adding something new to something else. And so you will always know that there is a following for that type of solution. And your challenge then is, in some cases, how to get the people from that particular company, or in other cases, how the extending the solution into something better will enhance the whole industry area, and people will go into buying the product because it's giving them something more than that's available in the market, but what they currently have is okay as well. So there's almost an opportunity here in some cases to actually create market by the solution, but in most cases the market will be around for the sort of solution you're bringing to it. And it is really important at this stage to convince the investors that you know what you need to know, which is the minimum of competitors, the key guys who would be directly competing with you, some of the features of their products. And it's a big part of it. Sometimes this is hard for people who are from a technical background, but this is as important as the development of the product to understand. So it might be that you find different ways of getting this information to make sure it's relevant and it stays relevant by the time you're sort of ready to go and pitch in front of investors.
So I come from an engineering background, so I like to understand how things are made up. So it's relatively easy to say that something like the global market for my product is £10 billion per annum, and the UK market is worth £1 billion of that, and we're going to capture 1% of that in 3 to 5 years, which is £10 million of revenue, something like that. But that doesn't tell me how you're going to achieve it or what you need to do to get there. It just tells me that the market is big. So I like to know from the bottom up how it's going to work. So things like identify who is your ideal customer, and you would have done that anyway as part of the solution definition. So understand who the ideal customer is, and then how many of those can you identify? How many do you know about right at this very moment? And then how many are there similar to the ones that you know about? Can you then identify enough of those to generate the revenue projections that you're going to create in the remainder of the deck? And then ask yourself, do you have enough resources to sell to them? So, say that we're going to make £500,000 of sales in the next couple of years. and each sale is worth £1,000, well, that means that we're going to have to do 500 sales over 2 years, which is roughly one a day. So do you have enough resources to sell to them? Do those numbers all add up? That's the question that ask yourself whenever you're creating the deck. And then you've got to think about how long the market's going to last. If you're entering into a market where you say, well, it's a clear blue ocean out there, there are very few competitors or no competitors, then and there's a revenue generating opportunity in a big market, then lots of other people will come into that marketplace. So how long is it going to last before you're forced to deal with all of the competitors? And then ask yourself, how long will it be before something else comes along that completely disrupts it? So those are questions that you need to think about when you're putting together the information and the research on the market opportunity.
Okay, and then obviously from the market size and your product development, you will sort of understand what the cost and the price your market will accept for your product, and that can lead to generating a revenue projection based on how many, as Bill said, you think you can engage with customers, how you plan to do that, how long do you think that will take? This is an area where traditionally it takes longer than you think. One of the hardest parts of doing anything with customers is trying to get them to give you some money for something you've developed. So it's a challenge that you've got to be ready for. Most of the time when they engage with you, there's always an interest. But some of the time, there's other things behind it. Maybe they're comparing you with something else and all that sort of stuff. So be careful that you only pick the projects that will really land for you, because this is an area where the investment is driven very much on how they see your proposition. If you don't have a revenue projection or over optimistic, then they will question the rest of what you're saying. Don't undercook it, otherwise you'll miss your opportunity to get the right amount of investment for the equity. It's a balance, but it's something that you do have to work on. And again, traditionally, it's an area where if you understand the market, you know your product well and the solution, it sort of can be worked through quite easily in the one sense, because there's no one else doing these sort of things. On the other hand, there's always something to compare. So just be ready for that conversation when you put these slides in front of people as to why those projections are going to be 85, 70% realistic. I mean, you know, they are projections after all. So don't get into an argument of saying they're 100% because you've done them mathematically. It's a challenge.
I think the summary of this slide for me is that it has to be realistic, you know, so be wary when you say we're going to generate tens of millions of pounds in a very short time. You know, can you justify that? And we've seen some very good decks where they have a model in behind the revenue projection. So that takes account of new entrants coming into the marketplace and the impact of churn. As Nitin says, it's hard to get customers to pay money. It's also a hard thing to do to keep them as well. So you've got to look after them. But if you've got the numbers presented in a model, then it's a simple matter of changing that under discussion with the investor. And you can ask the what if questions, the scenarios that will come into mind, and that will help show what the revenue projection is based on and how realistic it might be.
Well, this sort of goes on from the other slides in terms of sales and marketing. Now you've got an understanding of your product and how it will go into the market and the sort of predictions that you've made in terms of achieving targets for revenues. You've now got to get to grips with people wanting this. And one of the things that is very important is how you market. And how you market today in terms of new products is very different than how it used to be probably 2 years ago, because we're all at home now and we've all got lots of social media and stuff. So in a sense, it's easier because you've got a captured market and you've got channels that you can use. On the other hand, getting the right person to engage with who's got the capability of actually buying your product within an organization is still a key. So one part of it is marketing, so they understand that you've got something there that they may be interested in. The second is then achieving that sale, which is slightly different. And in a lot of cases, in an early stages, it needs to be the same person just because of the restrictions on costs and stuff. But they're two separate activities in terms of the overall business, because you do need to keep on looking at growing your presence in the market. I am a firm believer that the more you try, not sort of shotgun, but more specific, targeted, the more chances you have of creating a sale.
So as Nitin says, marketing and sales are two different functions, and it's important to remember that marketing is a cost on the business. So in the very early stages of the company, cost represents money going out. So you want to make sure, as Nitin says, that you do target your marketing activity to the places where your customers are going to be. So if you're going to sell a solution into an SME, it's probably not worthwhile advertising that on Instagram or maybe even Facebook, because those customers won't be looking at those particular areas. It may be that you want to put it in a trade magazine or something like that there. So you need to understand where your customers are going to be gathering and where they're going to see information, so that you can build that marketing strategy effectively. And then in your sales, remember that if you're selling to an enterprise customer, that can take a long while. So you've got a long sales cycle, so revenue can be slow coming in, and you may need lots of people or more people than you expect in order to engage with enterprise customers. Whereas a retail customer, that implies volume sales, and hence your business needs to be structured to have low overheads in it. But sales is always the thing that's bringing in revenue. So you've got to focus on that, but you've got to focus on the market as well in order to build up the brand and get people coming to you to buy your product or your service, whatever the solution is that you've identified.
Again, one area, and you can see there's the bulk of these slides are all around market and competition. It is very important that you do understand the market in terms of the competition that's out there for your type of product, and stretch yourself in terms of looking at competition. Can they actually change something that they're currently doing and overlap what you're doing? So there's always a challenge to be self-critical about your product and what the ability of your competitors could be if you were able to bring out the product and challenge their position. So it's very important you get to understand the competition in that area. Very sort of key to delivering the marketing message, that you understand what your product benefits are compared to what other people have on the market, and be fair. If they've got something better in a certain area, then highlight it. As long as your product is better overall, then that's where your opportunity will come from. So it's one of those where, you have to be very honest about what you see in other people's competition. The key thing on here, on this slide, is check your IP. Make sure that if you're generating something technical or very, very new, then either you get yourself in a position where you can get the IP and put patent around it, or if it's of that type, that you actually search and make sure you're not breaking someone's patent, because if you make a success of it at a low cost introduction, then they will come along and look out for you very quickly. But it is very important that you understand the competition in various forms. Most of the sort of software startups don't necessarily have the issue of IP in a sense, but they do get into sometimes issues of trade secrets and stuff. So be careful that, sometimes where you are using software houses to develop software, that you get a clear understanding of what is your secret of what you're developing and what they do as traditional outsourced suppliers. I
think it's important to establish whether you've done enough work to ensure that there is no competition. If you say there's no competition, because quite often, you will find an investor who's come to you because they're interested in what you're doing, and they themselves may well be aware of one or two competitors to what you're doing as well. So just be careful when you make the statement that there is no competition, that you can actually justify that. And the other thing is, don't dismiss the competition. Just say why you are better. And remember too that if you are able to patent something that the patent doesn't protect you, you have to always be looking on the lookout for somebody who's copying what you're doing, and then be prepared to defend your patent against them. So that's always a difficult decision for starting up businesses, because it can cost quite a lot of money, several £1,000s to create a patent. And by that's a lot of money taken out of the initial investment. So sometimes people prefer not to patent, because patenting actually publishes what you're doing for everyone to see. And rather they would want to be first into the marketplace and gain first mover advantage. So don't always think that you do have to patent. Discuss that within the team and make a careful and considered decision as to what you're going to do in regards to protecting your IP. Particularly if you're in retail business or hospitality business, be concerned about trademarks. It's quite easy to infringe somebody else's trademark. So do a check online to make sure that you're not in danger of infringing that trademark or being accused of passing yourself off as somebody else's trademark. And also, when you're thinking about competition, what are you going to do to keep ahead? Because if you're established, a good business that's doing well in the marketplace, other people will want to copy you and get in there. So what are you doing to keep ahead of that competition? How are you going to evolve your product set, or how are you going to develop your service that will keep you ahead of the competition? So, Josh, I think we're having another poll.
We are indeed. Thank you, William. So this poll should be on your screen now. And the question this time is, have you identified the IP, intellectual property, in your company? It's simple, yes or no. Fairly split between yes or no. We can see the majority haven't actually identified the IP within their companies. And I'll pass back over to you, William, and Nitin, to continue.
Thanks, Josh.
Okay, I think we're heading towards the end of our deck here. And again, this is the area that is difficult for an early stage startup, really, to understand the cost and the idea value in the market at this stage. That's why all the things that we've talked about before comes to help at this stage, because the model on how you do business in terms of understanding what will people pay for. Is it this actual product? Is it the service that goes along with the product? Or is it a service proposition that they pay regularly on a monthly basis, or they buy on a one-off? So at this stage, it's very important to understand the value and how that value is best sold to the customer. Is it something that they can get benefit as they use on a regular basis, which will then enable them to say, I can pay as I make the money from something and deliver it on a monthly basis? Or is it a product that they have to invest heavily up front to get the longer term benefit of improving the business, and how you go about engaging with that customer? Generally, it's very hard to start at a very high price unless it's very, very unique and the demand for that particular product is so high. Most of the time, you have to be ready to sort of change your direction as you get to engage with the market. But as you're looking at the differing models that will enable you to engage with the market, be careful that any customers you have benefit, if there is benefit to be gained from the changes you make. Otherwise, you will lose their loyalty. So as much as you're not always going to get it right the first time, and you may get some customers who will engage because it's appropriate for them to be with you at that stage. Make sure you remember them, and if you do change things or you make things lower cost by improving, that you give them the opportunity to sort of get benefit of all of that, which is then part of the loyalty that will build through you. Now, some of these things are longer term issues, but I think built in at the start of your thinking allows you to look at how you proposition your product into the market.
I think it's important, no matter what pricing model you use, and there are many pricing models that exist, is that you understand the costs in your business, because if you can't sell at a price that covers the costs and makes the margin on the top of it, then you haven't got a business. Now, it may be that you're in some industry sector where there is an established, well understood pricing model. So if you're offering something as a software as a service, there will be a traditional subscription model. So you may be stuck in that. That's what you've got to offer. But whatever it is that you offer into the marketplace, be able to clearly articulate it, because investors will drill into it. They'll want to know exactly what the cost build is that you've got in order to get to your pricing that you're putting into the marketplace, and you need to be able to justify that, and you need to be able to understand the sensitivity of different aspects of that model to changes that will come along. As you increase the number of employees, or as somebody else comes in and disrupts what's going on, you need to be able to have a good model and understanding of your costs, so that you can, understand what the impact of changes are on that.
As a part of the earlier discussion about the deck, we talked about the team, and some of the things that should include on the slide of the team is the pictures, some of the relevance of their experience, particularly to the business, and also in some cases, if it extends your ability to market and use the networks, also the areas where they've in the past been involved with. It's always important that actually you have a team of two minimum, and when we say two, mainly a business consists of someone who's got an idea, someone who's going to work on it technically, and then the third member generally is one who will take that to the market and do the selling. But it's important that you do have a partner at some stage at the early part of developing your whole business proposition, to make sure, one, you've got someone you can talk to during the period. Second, that you won't be able to do everything all yourself. And where you can, particularly where we talk about software, it's important that if someone technical is on board and they have the capacity to actually do some of the work themselves, that's valued more, because it sort of allows you to keep control of the whole project until you reach a certain stage where you can't develop things just because of lack of time. And also you have a very good understanding of the development. So it's all very important to do that. The other thing is take advice from the relevant people to help with guidance. One of the things myself and Bill do when we're talking to these decks with you is we always tell you what we think, but we never say you have to do it. And that's the big thing you must remember, that lots of people can advise you, but at the end of the day, you've got to get this business from an idea to the real world. So take what you are given in terms of advice, but ensure what you implement is yours.
It's just on that point of advisors, sometimes we see decks where they maybe have 10 or 15 advisors listed on the deck as part of the team, and you sort of question, is that real? They're probably people that they've spoken to once or twice or something like that there, and they're included just almost as a form of name dropping. So only include advisors where they are relevant, people that are mentoring you or coaching you, and people that you can turn to because they've got a contribution to make. And it's well worth, indicating that where you've got employees as well, and who's already, if they're part of the team, if they're already an existing investor, but again, where that's relevant.
And it's always important that you include a slide where people know exactly where you are at the point that you're talking to investors, and how much you've done. One of the things we do find that people actually don't update the decks in well enough is the fact that in a lot of cases, they're further on than they actually show in the deck. And that's very important, because how much work you've already done is very important to an investor, because he's looking to value what is to be done and how much he's invested in there. So the benefit of what you've already done is something he will measure against his investment. And there's a list of things there that are relevant, because all these things show how your business is developed from an idea to a stage where it's going to become real. So all these things, like awards and grants, give you more substance to go to the investor and say, you know, I've put my idea through this due diligence and I've received a grant. So it's all builds up to the fact that when you stand in front of investors, they've got something other than their own views as to why your idea will become successful.
Yeah, it's important that you include things that give an external validation to what you're doing. So that means it's not just you that's saying this is good, and the investor doesn't have to think as much about whether it's good. If somebody else has said it's good, then that's an extra piece of data that they can make use of. So things like grants or awards, if they're relevant, or if you've got trials in place and got feedback from customers, or you're already selling to customers, those things all add to the story of that this really is a useful business idea and has got traction in the marketplace. So add those things in that give the validation from outside. Don't include things like your 25-yard swimming certificate or something like that there, because that's not relevant. Add in the relevant things.
Okay, so just going back to the summary and really telling you, in terms of the deck, needs to tell the story. It is a story. It's a factual story built in with facts from different parts of the whole sort of process, like the market, like the technology, like the customers. So ensure that you follow a process that really gives you the opportunity to put across what you've been working on and how it sort of impacts the market.
Yeah, what we've done here is take you through sort of one dimension of the investor deck, which is the content of it. But remember that the investor is also looking at you, the individual, the founder of the business. So you've got to get across your own integrity in the presentation, if you're able to present alongside the pitch deck, and your own passion for the business. If you're not passionate about your business, don't expect the investor to be passionate about it, or anyone else be passionate about it. So there are some soft issues that have to come across with the pitch itself. So make sure that you can add in your experience and your knowledge and your skill as well as to how this is going to be delivered. And also, as you're building a team, as a founder, you're building a team, you will have a leadership responsibility. So make sure that that comes across as well, that you can lead a team of people to deliver this, and that it's realistic, and that you have got commitment to stay with this business and see it through, because all businesses, no matter what age they are, will suffer bumps on the road, and you've got to be able to respond to those, be resilient in dealing with it, and not give up at the first thing that goes wrong. And other things to make sure that's in the deck. Don't make the investor think. Lead them through a story where they don't have to think, but equally well, don't patronize them. Don't say things that aren't true, or that the investor will know that from his experience that aren't true, and make sure that everything is consistent. If you say the market is, £1 million per annum on one slide, then don't say it's $2 million on another slide, because that leads to inconsistencies. It makes the investor think about what's actually being said, and they may actually think, well, this person doesn't know what they're talking about. So make sure that you cover all of those things off. And always practice, always rehearse, war game the questions with friends, with colleagues, or anybody else that you can find. Make sure that you're able to give a good representation of you, the business. And I think at that point, we'll say thank you for listening. Thank you for taking the time out to attend the webinar. And Josh, I don't know whether there are any questions that we can.
None at the moment. If anyone does have any questions, please do put them in the Q&A. In the meantime, I'll hand back over to John.
Thank you, Josh. Thank you, William and Nitin. Do appreciate these. Question I have actually, there's a lot of information that needs to go into a pitch deck. Does it all need to go into one document, or would you recommend actually breaking some of the information down into separate documents to basically have it as appendices or as additional support documentation for that pitch deck?
I think the summary and the key is the stuff we've just got through. So 12 to 13 pages of getting you to that level of storytelling and where you want investment. Then substantial detail around each of the subjects that are hard to explain in that one page can go to appendices, and that can then relate to people wanting more information. So I think you're right, John. It doesn't all have to be on one slideshow, but it's important that it's related as a slideshow to give that incentive for someone to want to know more. So that needs to be reasonably complete, but the appendix can add to it. Bill?
Yeah, I think, remember the pitch deck is a summary of the whole proposition, and it's been developed on using other research background information models and what have you, which you'll not put into that summary, but which you will have created. And therefore those can be made available to the investor as well, because they will drill into the detail. It doesn't work the way that Dragon's Den says it works, where somebody does a pitch and Peter Jones reaches £50,000 to them from the side of his table. They'll go away and do due diligence, and there are lots of due diligence questions that come up after the initial pitch and the investor shows interest. Some of that will be information you will have gathered, and that could be in separate documents. And indeed, I think in the Space to Grow series, there is a webinar coming up about the due diligence questions that will be asked. So that's a plug for a webinar in the new year if anybody wants to attend that one. But yeah, keep the investor deck short, simple, concise, self-consistent, have detail in other documents and make that available so that when the investor asks the question, you can quickly answer those questions through the other documents.
Thank you. Got a question that's come through the Q&A about valuation. Now, we know valuation can be very, very tricky, but should the valuation be left blank?
No, at that stage, because you will have a difficult conversation about what you want investment as a figure. I think you do need to make an attempt at what you think is valued and really work on why you think it's justifiable for that value. And have a realistic conversation with the investor if it means changing it. But I think not having a value sort of takes away your opportunity to say, I want this amount and it'll be a percentage of where I've reached. And I think you can only sort of get to a position where you want to investors to invest in you when you sort of know those sort of things. So I just believe you do need to get some sort of value, but do the work around why you think it's that value. That's my key on that.
Yeah, remember, you're going to sell something. You're going to sell a percentage of the company in the form of shares. So if you're selling part of that company, you need to know what it's worth. I mean, it's maybe a trite example, but if you're going to sell a car, you have a rough idea of what it's going to be worth, and you have different ways of doing that. You can compare it to what other cars of the same age are like. You can compare it to what somebody else has sold one recently is like, or you can say, well, I'm going to sell it for because it's got a good engine in it and it's got a good gearbox and all the rest of it. So the assets that are in it are good, and you can use, and it's the same principles are used to value the company. You know, you can decide that you can compare it against other businesses of a similar kind who have been sold recently or on the marketplace. Or another way of doing it is the assets that are in the company, what are they worth? Or what is the business going to generate in terms of revenue or profitability in the future? So all of those give you an indication of what the value of the business is. It is very much an art rather than a science, but the science based on those numbers gives you a starting point, and thereafter it becomes a negotiation with the investor. But as long as you know, as Nitin says, you've got a starting point that you can justify, then you can enter into the negotiation with confidence, and you know when you're being asked to sell it too cheaply or asked to sell too much too cheaply. You know that's something that you will then know based on the work that you've done, and you can decide not to sell at that point. You don't have to sell. Remember, you don't have to sell if you don't want to.
We're getting quite a few questions coming in now. There's one here about adoption rates, FSCA rates. Even if the business model or the value proposition is good, consumer behaviour could be hard to change. So do investors actually ask for details of the FSCA rate or the adoption rate?
I think it's up to you to ensure that you give them the information that's relevant for them to understand. So in a sense, if it's a new product, very hard to adopt, but you know there's a longer term market for it, then I think it's important that you show them a trend that there is a uptake in these. It's slower maybe than where you predicted, or it's going to be slow because of where, and then there'll be a period where the market will change. So I think it's case by case, but certainly I wouldn't take it the other way and assume that the market doesn't know because it's not taking it up. I'd start from the understanding of what's stopping the market reaching that. And then if you understand clearly it's new technology, it's very different, then look at trying to justify why it's not doing what it's set out to do.
Yeah, I think from the investor perspective, I think that's why it's important to understand what the problem is you're trying to solve and why your solution solves it effectively, so that you'll understand why people will come and buy from you. And then in the early days, you won't know, how easy it is to change people's behavior and for them to adopt it. But you'll get some examples from the sales that you've got. So if you can identify your ideal customer and then go and sell to them, you'll quickly get feedback from the customers to what's right and what's wrong, and that will give you guidance for the future. But I don't think investors will ask for a scientific number, but they'll want to have a feeling for what the customer base is likely to be, how many of those they can identify with, and how then that will translate into market take-up in the future.
Okay, and we've got a final question before we wrap up. Seeking investment for returns rather than shares, and I assume the questioner here is talking about convertible loans. What advice would you have for doing these?
I think, John, you might be the best place to answer that one.
Yeah.
I probably am, actually.
Yeah, go on, John.
Okay, convertible loans, and I assume you mean convertible loans in the way of returns, which is actually providing interest rather than share valuations. There's a mixed feeling about this. The Future Fund, which is a government-funded support for businesses, they prefer convertible loans, and this is because it lowers the risk, and it also means that there is a better chance of a return of investment in some form or other. It also can be very useful for very long-term investments. In other words, you want to invest, you don't really want to be shareholders, you don't want the paraphernalia of shareholders, and it does mean that even if the business really takes off, you'll get a return in the form of your fixed rate of interest from the shares. And if it's the next Amazon or the next Google or the next Facebook, and it's bought out, then you will get a return because it will be converted to shares and you will get a valuation based upon its current valuation. So it's speculative in that regard. Of course, it is a loan, and people, quite rightly, sometimes they're adverse to loans. Sharia law and what have you could mean that they're not really appropriate for that type of business. So the whole matter about getting returns rather than shares is a big debate. And really, it comes down to personal preference and personal choice when it comes down to that.
Yeah, and the final thing, sometimes you don't have a choice. I mean, if you believe in a project and you're reaching a stage where you're looking for investment, then look at all options, because you might just need that jump start to get you going on a road. So be open to various suggestions, but be careful that it sort of overall meets your lifestyle and where you want to be as you progress in your business.
Yeah.
I mean, certainly convertible loans often don't come with personal guarantees like a bank loan would. So it wouldn't be an encumbrance upon you because the loan is with the company. So if the company folds, the loan folds with it.
Yeah. And many businesses grow successfully on the back of debt and with organic growth. So you don't have to seek equity investment. There are other ways of getting the funding for the business.
Yeah. So there are pros and cons, and it really is 50% either way. The jury is not out on that one.
Yeah.
So, I think we have no more open questions. So it only goes to show that there is a lot of knowledge out there, a lot of support available to any business starting out that wishes to go down the route of investment. And we are here to help those businesses. As I say, we're looking for those innovative game changers, new to the industry, and the help and support that we can provide spreads right across the university. So be prepared to be shocked by the amount of support that we can provide to you. I look forward to seeing many of you at our future webinars. They start again in January, and please make sure that you attend because they're well worth seeing. I look forward to meeting you and have season's greetings from me. Thank you. Thank you, William. Thank you, Nitin. Thank you, Josh. Goodbye.